Hello, today is Wednesday, the 7th of January, 2009. This is Brian Shannon from alphatrends.net. We had some selling in here today. The market has been rising on light volume. Yesterday we saw the heavier volume, and when you see heavy volume towards the end of a move, a lot of times it means distribution. Now we can look back, obviously, and say that that's exactly what did happen. I've been suggesting that we wanted to be cautious because of the extended nature of this rally. We had gotten above the recent resistance, that is from the last 6 weeks or so, on the first day of the year with that big move higher. We are still higher on the year, and we are still above the 10, 20, and 50-day moving averages. So all is not lost here, but it just shows you that you really have to be on your toes in this market. There's very little trust for anything out there. When you see companies that come out and lie straight to the cameras with this SAY, for instance, which never even opened today, but I saw it was indicated under $1 a share after their CEO lied about what was happening there. It just really creates or continues to place an environment of mistrust, and during that time, you've got to be very nimble. We've seen this rally, very steep trend line in here, and just a real nice classic higher highs and higher lows. Right up until we'd seen the trend line tested yesterday afternoon, and of course we obviously gapped lower down through the support, and then this level right here, which was one of those higher lows, was tested, as was this level early on right at the and I pointed out on the blog earlier that the potential for support was going to be found early on near the conjunction of the 38.2% retracement of this rally here that we've seen. I didn't mean to, let me just change that. 38.2% of this rally brought us down right here towards about that 30.5 level where the 5-day moving average was. We did get an initial bounce there, but as we can see, that bounce fell, came right up to this prior level of support. Sellers were found there, and we saw another drive lower in the afternoon. On the 1 minute time frame, you can see that we kind of chopped around sideways, and then this is really where the floodgates opened back up and that VWAP started turning back lower. We had the lower highs and lower lows in here. So this market remains just best suited for a very short-term trader's bias. I'd shown some of those beaten down stocks and the huge percentage moves that they've seen this year. I've been pointing them out since early last week or middle of last week, and yesterday I pointed to those as saying when the level of speculation gets so strong that I can post a list of 8 stocks and on average they gain 14.5% that day, then it tells you that there's a little bit too much speculation in the market and time to kind of rein in the risk a little bit, because that kind of level of speculation often comes near a short-term turning point, and that's in fact often a very good sign, which it was today. So right now where we are, we're up for the year. We're below the 5-day moving average, so we need to be cautious again. On the daily time frame, we want to now see that these levels in here with these moving averages hold. Let's take a look and see what those are. We'll just go ahead and do a snapshot view. You can see the 10-day moving average at 29.65, the 20 right there and about the same, the 20 and 50 all kind of clustered together right around there, $29.70. If the market gets down towards that level, that may be a good place to look to do some buying here if we get a little panic move. And you can also see that level is going to take on significance here, because this level, 29.66, is also 2/3 retracement of this. So this is going to be a very important level in here tomorrow. We had this support after breaking the resistance in that area. So there's a lot of reasons to think that if the market gets down towards that level, that may be where we see some buying. So keep a close eye on this level tomorrow or the next day if we get down there. Short term, the trend obviously reversed back to lower in here today. Much longer term, we're still in a big downtrend. You can look at this as maybe a bearish flag. I don't like to look at the weekly time frame so much, because by the time the pattern's set up, there's been 50 trades on the shorter term time frames to take advantage of. So that's more for an investor standpoint, and if you're an investor in this market, I think you're nuts. But that's not for me to say, basically. So didn't mean to offend anyone there. But 29.50, 29.60, right in that area is going to be a very important level for the NASDAQ. Let's take a look at oil. Oil, as we saw, we're still in a downtrend below the declining 50-day moving average, and all rallies should be treated as, if you're going to trade them, as short-term trades. And we'd seen, like I was saying yesterday, the pattern of higher highs and higher lows is what should be your guidepost for taking action. Yesterday we'd seen the lower high in here, and I'd suggested that breaking down through 37 might lead to a test of that 5-day moving average at $35 a share. And I had also pointed to the Fibonacci retracement, that it was right around in that same 35 area. Well, perhaps we're going to continue back down towards 33 here. These are only, these Fibonacci levels aren't a reason to buy, nor is the 5-day moving average. They're a reason to look more closely at the action in that area. So if you look here at this initial sell-off, it came down. That's not what I meant to do again, but it came down, and it never got back above the daily VWAP. You want to see, if you're going to trade for a bounce, you want to see, like we saw in here, these higher lows. It had some resistance in here. If it was able to make it back above that daily VWAP because it was flattening out in here, then perhaps there would have been a reversal back up. But it stayed lower, the trend remained down, and we closed pretty much right on the lows for oil today. And obviously we're still in a very bad downtrend here with the daily time frame. Real big volume in here. This whole market's been trading massive volume, for the last several weeks. So again, if they don't scare you out on the way down, they'll typically wear you out. Volatility usually diminishes during that process, but the first few bounces are still spirited. They trap a lot of longs in here who might not come back next time, so the next rally may not be as high. And that's part of the bottoming process that's going to be present in all these markets. The semiconductors we had seen yesterday got definitively above this level here that had been defining that cup and handle, and it was extended as it got there. Today we saw that the market broke down on a gap, down towards this level. It tested the 5-day moving average. That prior resistance acted as resistance once again. Further selling in this market. As far as Fibonacci goes in here, we can take a look at a retracement from the late December lows to just the highs yesterday. We came down to a 50% retracement, and the 61.8% would be right around $17.70. So it's not all completely broken here, but the trends just remain overall. We're still in a bear market, and you have to, as tempting as it is to look at these rallies and try and become encouraged by the action in them, you've got to look at them as just trading trends only. When we look at weekly time frames, it takes a while for a market to make a tradable, for an investor to get involved. You need those 40-week or 200-day moving averages to flatten back out. We're still obviously in a very bad downtrend in all these markets. It's the Russell 2000 we're looking at right now. The Russell has been the strongest over the last few weeks, and it does remain above this prior level of resistance right around $49 a share, also above the 10, 20, and 50-day moving averages. So it remains in the best shape, but short term, it's still, I don't know why that just went to the IWM or semis, but here we're still, we've got lower highs and lower lows in the short term, so we need to see this market stabilize, maybe above $49 a share. Maybe we get a little bit further shakeout down towards 48. If you remember earlier in the week or late last week, I was saying for all these markets that I would prefer that we get a shakeout before the next rally higher, if we get a next rally higher, but we got to remain open-minded to it. Similar to the Mexican market, where it rallied up beyond that 50-day moving average and then pulled back pretty sharp down towards that conjunction of the 10 and 20, then another rally, then the 20 right in here, another rally. So, these bottoming processes tend to be volatile, but the good news is for short-term traders, all that volatility just means opportunity. The financials have been the weakest, and we've been talking about the 50-day moving average in here acting as resistance. Continues to. The market fell from that level in here today on a 10-minute time frame. Let's take a look at the 30-minute time frame rather. The 30-minute time frame, we've been focused on this $11.90 level. So below $11.90, perhaps we go back down and test this $11.50 level. If 11.5 doesn't hold, then you've got to look at this whole thing as potentially unwinding once again, and it's certainly within the realm of possibility. We've got these lower highs, we've got more frequent tests of that, so you've got to remain open-minded to moves in either direction here, and just be very careful in this environment. The financials remain badly damaged as far as Fibonacci on this group goes. We're we're right at the 2/3 retracement, and it's at a pretty critical level, or close to it, near that $11.90 area. The S&P 500 on the daily time frame, it broke past that 92 level, as we know, right in here, just on the first day of the trading year, and then pulled back down. Let's just zoom this scaling in a little bit so we can see it more clearly. But we are bullishly above the 10, 20, and 50-day moving average, and that 50-day moving average is actually advancing. Let's take a look at the numbers in there, because those moving averages are clustered between 89 even for the 50-day moving average, 89.25 for the 10, and 89.40 for the 20-day moving average. So that 89 and a quarter level is going to be important for the short term to hold. And if we take a look in here at retracements on the S&P 500 as well, let's take a look in here, get Fibonacci. We'll see that 89 is in fact a 2/3 retracement of this move from the December 29th low. So we've got 89 is a very 89 is an important level for the S&P 500. If it pulls back down towards that level, I think you want to start monitoring your shorter term charts to look for a potential long entry, very similar to the level that we see for the NASDAQ down near its 10, 20, and 50-day moving averages. And again, those levels were just under that, just under $39 a share, $29 a share.